Remember those days? Feels like ages ago, but wasn't. Maybe 2020. When getting a mortgage, it felt almost weirdly easy. Rates were just so low.
Oh, yeah. Scraping the bottom.
Totally.
Yeah.
Or, flip side, maybe just recently you've been thinking about, I don't know, upgrading the car, finally doing that kitchen reno, but the cost of borrowing just feels heavy.
Definitely heavier than it was. A lot heavier for some things.
Right. And maybe you've seen the headlines, too, about layoffs, even in places like big tech, places we thought were kind of untouchable.
Yeah, those headlines have been popping up.
Well, if any of that sounds familiar, it's not just random stuff happening. It's all kind of connected pieces of a bigger picture, and often, maybe indirectly, but often tied to decisions made by this one really powerful, maybe slightly mysterious group, Federal Reserve.
The Fed, yep. They're sort of behind the curtain on a lot of this.
Exactly. So today we're going to really dive into the sources you sent over, our mission, to pull out the key stuff, the nuggets, to unpack how the Fed, the central bank, doesn't just move markets in theory, but actually impacts your money, your choices, every day.
And the whole economy swirling around us.
Yeah, we'll look at what the Fed is, what tools they actually use, how their moves hit things like your loans, your savings, your investments.
And even how those waves reach shores far away, like, say, Vietnam. We'll dig into that, too.
All right, so let's start at the beginning. What is the Federal Reserve, really?
Okay, fundamentally, it's the central bank of the United States.
Yeah.
Simple as that sounds, think of it as the conductor, the maestro of the world's biggest economy.
Right, conducting this huge, complex orchestra of money and jobs and growth.
That's a good way to put it. And they're not just waving the baton randomly. They have very specific goals they're trying to achieve.
That's the dual mandate we hear about, right? Two big things at once.
Exactly. Congress gave them two main jobs. Price stability, which is basically keeping inflation low and predictable so your money holds its value, and maximum employment, getting as many people working as is sustainably possible.
Okay, and hitting both of those at the same time. That sounds tricky. Sometimes they might pull in opposite directions.
Oh, absolutely. That's the constant balancing act. Sometimes boosting jobs might risk higher inflation, and fighting inflation might slow down hiring. It's the core challenge.
So how do they do it? What's the main lever they pull to try and manage this balancing act?
The big one, the one everyone talks about, is setting a target for a key interest rate, the federal funds rate.
Okay, federal funds rate. Now, that's not the rate I pay on my credit card, right? It's something else.
Correct. It's a very specific rate. It's the interest rate banks charge each other for lending money overnight, like literally just for one night.
Why do banks need to borrow from each other overnight?
Well, they used to have to hold a certain amount of money in reserve based on their deposits. That specific requirement was actually dropped to zero back in 2020. But banks still need to manage their cash flow day to day, make sure they have enough funds readily available for transactions, payments, customer withdrawals, things like that. So they borrow and lend reserves among themselves constantly in this market.
Got it. So it's an interbank, super short-term rate. And why is that rate so important for the rest of us?
Because it's foundational. Think of it as the base cost of money in the banking system. Changes in the federal funds rate tend to ripple outwards, influencing almost all other short-term interest rates, and eventually longer-term rates too, like the ones you do see on loans and savings accounts. It sets the tone.
Okay, the foundational rate. And who decides where this rate should be?
That decision falls to a specific group within the Fed, the Federal Open Market Committee, or the FOMC.
Right, the FOMC. We hear about their meetings in the news all the time.
Yep, they're the rate-setting body. They typically meet 8 times a year on a schedule. But, if things get really turbulent in the economy, they can, and sometimes do, hold emergency, unscheduled meetings to take action quicker.
Okay, so the FOMC sets the target. But how do they make sure the actual rate banks charge each other hits that target? They don't just announce it and hope for the best, do they?
No, definitely not. They have a whole toolkit of operations they use to steer the actual or effective federal funds rate into their target range and, more broadly, influence the amount of money flowing through the system.
The famous toolbox. What's in it?
Okay, let's run through the main ones from your sources. First up is something called interest on reserve balances, or IORB.
Interest on reserves, even though they don't technically have to hold reserves anymore?
Right. Banks still keep accounts at the Fed. They still hold balances there, and the Fed pays them interest on those balances. By adjusting the IORB rate, the Fed influences a bank's choice. Should I lend my extra cash to another bank in the federal funds market, or just park it safely at the Fed and earn the IORB rate?
Ah, okay. So if the IORB is pretty good, they might just leave the money at the Fed.
Exactly. It basically sets a floor. A bank isn't likely to lend money to another bank for less than it can earn risk-free just by keeping it at the Fed. So IORB helps anchor the lower end of the federal funds rate target range.
Makes sense. What else?
Then you have the big one, historically speaking, open market operations, or OMOs.
This is the buying and selling of government bonds, right? That always sounds very efficient.
It is, and it's crucial. FOMOs involve the Fed buying or selling U.S. government securities. Think treasury bills, notes, bonds on the open market, dealing with major financial institutions called primary dealers.
And how does buying or selling bonds change interest rates?
It's all about liquidity, the amount of cash reserves in the banking system. When the Fed buys securities, it pays for them by crediting the seller's bank account at the Fed. Poof, new money, new reserves injected into the system. More money available makes borrowing cheaper, so it puts downward pressure on the federal funds rate.
Okay, buying equals more money, lower rates.
Yep. And when the Fed sells securities, the buyers pay the Fed, and that money, those reserves, are pulled out of the banking system. Less money available makes borrowing more expensive, pushing rates up. The Fed uses these operations daily, really, to fine-tune the supply of reserves and keep the effective rate where they want it.
So it's like turning a tap, adding or removing cash from the system day to day. What if a bank just needs cash directly from the Fed, maybe in a pinch?
That's the discount window. It's a facility where eligible banks can borrow directly from their regional Federal Reserve Bank, usually just overnight. The interest rate they pay is called the discount rate.
Is that the same as the federal funds rate?
No, and that's important. The main discount rate, called the primary credit rate, is usually set above the target for the federal funds rate. That's intentional. It encourages banks to try and borrow from each other first in the federal funds market before coming to the Fed's window.
So it's more like a backstop, not the main tool for setting the daily rate.
Exactly. It's a safety valve. There are also other rates, like a secondary rate for banks with more issues, and seasonal credit for smaller banks with predictable funding swings, like farm banks. But banks need collateral to borrow there. It helps put a ceiling on the federal funds rate because a bank generally wouldn't pay more to borrow from another bank than it would have to pay at the discount window.
Okay, floor with IORB, ceiling with the discount rate, and fine-tuning with SOMOs. Anything else?
Yes, repurchase agreements or repos. These are also really important for managing liquidity, often just overnight.
Repos. Sounds complicated.
It's basically a short-term loan collateralized by securities. In a standard repo, the Fed buys securities from a bank with an agreement to sell them back the next day at a slightly higher price. Effectively, the Fed is lending cash to the bank overnight.
Okay, lending cash.
And in a reverse repo, the Fed sells securities to a counterparty with an agreement to buy them back the next day. Here, the Fed is effectively borrowing cash, draining liquidity from the system temporarily. The rate on the overnight reverse repo facility, the RRP, is another key tool that helps set a floor under short-term rates, because eligible institutions can park their cash there risk-free.
Wow, okay, that's a lot of intricate plumbing. Now, separate from these daily operations, the Fed bought trillions in assets during the pandemic and after 2008. Its balance sheet got huge. How does that fit in?
Right. That brings us to quantitative tightening, or QT. This is the opposite of quantitative easing, or QE, which was those massive asset purchases.
So QE was buying bonds, QT is selling them.
Not exactly selling, typically. QT usually involves the Fed simply not reinvesting the money it gets back when the bonds it holds mature. So a Treasury bond matures, the Treasury pays the Fed back the principal, and instead of using that money to buy a new bond, the Fed just lets the money disappear from its balance sheet.
So the balance sheet just shrinks over time as bonds mature.
Precisely. And as the balance sheet shrinks, reserves are drained from the banking system over the longer term, which tends to put upward pressure on longer-term interest rates and generally tightens financial conditions. Your sources mentioned the market thinks this QT process might wrap up sometime in 2025, and the Fed's been actively discussing how and when to best manage that wind down.
Okay, deep breath. That's the Fed's machinery. Now, let's connect it back. How does all this maneuvering, the rates, the FOMOs, the QT, how does it actually impact us, regular people? Our money, our decisions.
Right. This is the crucial link. The Fed's actions, especially on the federal funds rate, absolutely ripple out and hit your personal finances in very real ways. Probably the most direct impact is on your borrowing costs.
Okay, let's talk about that. How does the federal funds rate change what I pay for, say, a car loan?
Well, the federal funds rate influences other key benchmark rates, like the prime rate. Lots of variable rate loans, think credit cards, home equity lines of credit, or ECLO cause, are directly tied to the prime rate. So when the Fed hikes its rate, the prime rate usually jumps up almost immediately, and your credit card or ECOSC rate follows soon after.
And other rates too, like mortgages or auto loans.
Other rates tend to follow, though maybe not as lockstep as the prime rate. Things like SOFR, another benchmark rate that's becoming more common, are closely linked. Even fixed rates, while not tied day to day, are influenced by the overall interest rate environment the Fed creates and market expectations of future Fed moves. Even the anticipation of a Fed hike can push market rates higher before the official announcement.
But we've definitely seen that happen dramatically over the last few years. Rates went from rock bottom to, well, not rock bottom anymore.
Absolutely. The bank rate data in your sources really paints a picture. Comparing July 2021, near the low point, to April 2025, the increases are stark. A $30,000 HELOC, the average rate jumped 3.7 percentage points.
Wow.
Credit card rates, up almost 4 percentage points, 3.93 to be exact. Car loans saw big jumps too, used cars up 2.85 points, new cars up 3.15 points. That translates directly into higher monthly payments, much higher total interest paid.
Yeah, that adds up fast. If I have a variable rate, like a credit card, how quickly does that hike hit my bill?
Usually pretty quickly, often within 1 or 2 billing cycles after the Fed makes its move.
But if I have a fixed rate loan, like an old mortgage I got back in 2021.
You're golden on that one. Fixed means fixed. Your rate and payment don't change just because the Fed is hiking rates now. That's the big benefit of locking in a fixed rate when rates are low.
Now, the sources mention Liz Ewing making a point that banks don't just robotically follow the Fed, right? There's some wiggle room.
That's a really important nuance. The Fed sets the underlying cost of funds and then general direction, but the specific rate you get offered depends on other things too. Your credit score is huge, obviously.
Right.
How much competition is there among lenders? What kind of loan is it? And the bank's own business strategy and profit margins. So yeah, the Fed points the way, but the final destination for your rate involves those other factors.
Okay. Now, what about the big one, the 30-year fixed rate mortgage? That seems to have a life of its own sometimes. It doesn't track the Fed funds rate directly, does it?
You're absolutely right. That's the exception, and it's a big one. While Fed policy influences everything eventually, 30-year fixed mortgage rates tend to track the yield on the 10-year U.S. Treasury bond much more closely than the overnight federal funds rate.
And why the 10-year Treasury?
Because it reflects the market's longer-term view. The 10-year yield is driven more by expectations about inflation over the next decade, expectations about long-term economic growth, and the global supply and demand for safe, long-duration assets like U.S. government debt.
So the Fed could be hiking its short-term rate, but if the market thinks inflation will be lower in the long run, mortgage rates might not rise as much or could even fall.
Exactly. Or vice versa. We saw incredible swings. Your sources note mortgage rates hit a mind-boggling low of 2.93% in January 2021. Then, as inflation fears exploded and Treasury yields surged, they peaked over 8%, 8.01% in October 2023. By April 2025, they were back down a bit, around 6.81%.
That peak over 8% was brutal for homebuyers.
Absolutely. And interestingly, as Greg McBride points out in the source material, sometimes when mortgage rates fall, like they did from that 8% peak, it's not actually good news. It can be because the market is getting worried about economic weakness or potential recession, causing investors to flee to the safety of Treasury bonds, which pushes down those yields and consequently mortgage rates. So lower isn't always better if the reason is fear.
Okay, that covers borrowing. What about the flip side, our savings? Does the Fed help us there when rates go up?
Yes, finally some good news for savers. Yields on savings accounts, money market accounts, CDs, they also tend to follow the Fed's lead, moving higher when the Fed hikes.
Why is that?
Well, when the Fed raises rates, banks can earn more on their own reserves parked at the Fed, remember IORB, and the overall return on safe short-term lending goes up. To attract or keep customer deposits, which they use to fund their lending, they need to offer more competitive rates. After years of near-zero returns, the Fed's rapid hike starting in 2022 led to savings yields we hadn't seen in, over a decade.
Yeah, it felt like a different world for savings accounts for a while there.
It really did. The sources mentioned some pretty juicy peak yields, like a 5-year CD hitting 4.85%, a 1-year CD reaching 5.75%, and some high-yield savings accounts even touching 5.55%.
Wow. And where were they more recently, like April 2025 after some expected cuts? Still decent.
Still pretty good, historically speaking. Around 4.15% for a 5-year CD, 4.4% for 1 year, and 4.5% for high-yield savings. And crucially,
They're beating inflation.
yes. With inflation reported around 2.4% in April 2025, those yields meant your savings were actually growing in real purchasing power, not just keeping pace or falling behind. That's huge.
But there's a catch, right? Not all savings accounts were paying that much.
Oh, definitely not. Big difference. The sources highlight the national average savings yield was still pitifully low, like 0.47%. That really shows the gap between, say, big brick-and-mortar banks and many online banks.
Why can online banks usually offer more?
Lower overhead, no expensive branches everywhere. They can pass those savings on as higher deposit rates. So the lesson for savers is clear. You really have to shop around, especially look at online banks, to get those top yields that reflect the Fed's rate environment. Don't just settle for the default rate at your big bank.
Good advice. Okay, so rates affect the cost of borrowing and the return on saving. What about actually getting a loan? Do higher rates make lenders tougher?
Yes, that's another key impact. When rates go up significantly, lenders tend to get more cautious. They tighten their lending standards.
Why? Just because they can.
No, it's mainly about risk. Think about it. Higher interest rates mean higher monthly payments for borrowers. That takes a bigger bite out of their income, leaving less cushion if they hit a rough patch, like losing a job. So from the lender's perspective, the room of the borrower defaulting goes up, especially for people with lower credit scores or less stable income.
So lenders get pickier about who they lend to.
Exactly. They might require higher credit scores, bigger down payments, lower debt-to-income ratios. This tightening of credit access is actually part of how higher rates work to slow the economy. Fewer people and businesses qualify for loans, so there's less borrowing and spending on big-ticket items like houses, cars, or business equipment.
And the data shows this happening.
Oh, yeah. That Bankrate poll mentioned in the sources, covering late 2023 to late 2024 when rates were high. Nearly half, 48% of people who applied for a loan or credit product were denied.
Wow, almost 1 in 2. That's huge.
It really illustrates how credit conditions tighten. And Greg McBride points out, this tends to hit borrowers perceived as riskier the hardest. They might find it difficult to get credit at almost any rate when standards tighten up. Just look at that mortgage example again. A $500,000 loan payment jumping from about $2,100 a month to over $3,200 a month when rates went from under 3% to nearly 7%. That's a 56% increase. It completely changes the affordability calculation for borrowers and the risk assessment for lenders.
Okay, borrowing, saving, getting loans. What about our investments, the stock market? How does the Fed factor in there? Does Powell control Wall Street?
Not directly, but the Fed has a huge influence. When the Fed raises interest rates, those safer investments we talked about, bonds, CDs, high-yield savings start looking more attractive. Their yields go up.
So why risk the stock market if you can get a decent, safe return elsewhere?
Exactly. Money tends to flow towards safety and yield. So some investors might sell stocks and move into bonds or cash, putting downward pressure on stock prices. Higher rates also make it more expensive for companies to borrow, which can hurt their profits and expansion plans. And maybe most importantly, there's the fear factor. Fear that the Fed's rate hikes will slow the economy too much, maybe even cause a recession. If investors anticipate a recession, they get nervous about future corporate profits and tend to sell stocks. We saw this play out dramatically. In 2022, the S&P 500 had its worst year since the 2008 financial crisis, largely driven by Fed tightening and recession fears.
And the opposite happens when the Fed cuts rates. Stocks go up.
Generally, yes, that's the tendency. Lower rates make bonds and savings less attractive, pushing investors towards riskier assets like stocks in search of better returns. Lower rates also make borrowing cheaper for companies, which can boost investment and potentially profits. But
there's always a but.
Yeah, always. The stock market is complex. The Fed is a huge factor, but not the only one. Your sources mention other things influencing volatility, like President Trump's trade policies in the March 2025 context, geopolitics, earnings surprises, new technologies. Lots of things move markets.
So for the average person with a 401k or an investment account, what's the takeaway? Should we panic sell when the Fed hikes?
Absolutely not, according to the advice from Greg McBride in the sources. For most long-term investors, like people saving for retirement, the key is perspective. Don't react to the short-term swings driven by Fed speculation or news headlines. Focus on the long run.
Because a healthy economy eventually lifts stocks.
Right. Over the long term, a growing economy which the Fed, despite the bumps, is trying to foster supports corporate earnings and ultimately stock prices. Those downturns, while scary, can even be buying opportunities for investors with a long time horizon. buy low, sell high, or rather buy periodically and hold long-term.
Okay, let's talk about purchasing power. The value of our money. How does the Fed affect that?
This ties right back into that dual mandate, especially the price stability part. When the Fed keeps rates super low for a long time to boost the economy, like after the financial crisis or early in the pandemic.
It can lead to too much demand.
Exactly. If demand grows much faster than the economy's ability to supply goods and services, maybe because of stimulus checks, low borrowing costs, and maybe supply chain issues like we saw post-COVID, then prices start to rise. That's inflation. And inflation directly erodes your purchasing power. Each dollar buys less.
So low rates can sometimes fuel inflation, and high rates are the medicine.
That's the idea. Higher rates make borrowing more expensive, which cools down spending by consumers and businesses. Less demand takes pressure off prices. The Fed is often called the country's #1 inflation fighter because monetary policy is seen as the most powerful tool to manage overall price levels.
But again, that balancing act. Fighting inflation is good, but if they slow things down too much.
That's the other major risk to purchasing power. Losing your job. While inflation chips away at the value of your money over time, becoming unemployed can wipe out your purchasing power almost instantly because your income disappears. So the Fed tries to curb inflation without causing a deep recession and widespread job losses. It's incredibly difficult.
Which brings us squarely to the job market. How directly do Fed rate decisions impact jobs and job security?
Very directly. Think about a business considering an expansion, building a new factory, launching a new product line, hiring more staff. When interest rates are low, the cost of borrowing money for that expansion is cheap, making the project look more attractive and feasible.
Makes sense. Easy money means easier to grow and hire.
Right. But when the Fed hikes rates significantly, the cost of financing that same project goes way up. Suddenly, it might not look profitable anymore. So businesses might delay projects, scale them back, or cancel them altogether. And that translates directly into slower hiring, hiring freezes, or even layoffs.
And the data shows the job market cooled off after the Fed started hiking in 2022.
Clearly. The sources lay it out. Unemployment, which had hit a low of 3.4%, started ticking up. It was holding above 4% from May 2024 onwards, hitting 4.2% by April 2025.
That's quite a move.
And job growth slowed noticeably. We went from adding maybe 300,000 jobs a month 2 years prior to averaging closer to 193,000 more recently. Maybe the most telling sign is job openings. They fell from a peak of around 12 million way down to about 7.2 million by March 2025. Fewer openings mean less opportunity for job seekers and less power for workers to demand higher wages.
So people were feeling this change.
Seems so. That September 2024 survey found 21% of workers felt their job situation had gotten worse since the hikes began. We saw the specific layoffs in big tech, which may be overhired during the boom. Plus, the sources mentioned other drags like federal layoffs and uncertainty from tariff policies. It even notes that recent monthly job cuts, if you exclude the crazy pandemic year of 2020, were actually the highest since 2009, largely due to government layoffs.
It sounds like this cooling job market started to change the conversation around the Fed's priorities, shifting focus from just inflation.
Exactly. By mid-2024, as your sources mention, there was this growing narrative pushed by economists like Joe Brusuelas and Mark Zandi that maybe the biggest risk wasn't inflation anymore, but unemployment.
The fear being the Fed might keep its foot on the brake too long.
Precisely. They'd successfully used high rates to bring inflation down from those really painful peaks.
Yeah.
But the worry became, if they stay too restrictive for too long, they could overshoot, unnecessarily damage the labor market, and maybe even tip the economy into recession.
Even though job growth was still happening, just slower.
Yeah, Chair Powell called the June 2024 growth of 206K jobs balanced, not too hot, not too cold. But the economists were saying, be careful, that balance could be fragile if you keep policy this tight. There was talk about the SAM rule potentially being triggered. That's a recession indicator based on rising unemployment. And Kim noted weakness occurring in the service sector. The risk balance seemed to be shifting.
It really does sound like a constant tightrope walk for the Fed, making huge decisions based on data that's always looking backward, trying to predict the future.
That's the inherent challenge, and it leads into how they actually make these decisions and communicate them. Your sources stress how data-dependent the FOMC is. Before every meeting, they are intensely analyzing all the latest numbers, inflation reports like CPI and PCE, the jobs report, GDP growth, spending, investment, everything.
And even with all that data, the people making the decisions don't always agree on what to do next.
Not at all. That's where the famous dot plot comes in. After some meetings, they released this chart showing where each FOMC member anonymously thinks the federal funds rate should be at the end of this year, next year, and further out.
And the dots are often all over the place.
They can be, especially when the economic outlook is uncertain. It visually shows the disagreement. The March 2025 context you provided is a perfect example of uncertainty about rate cuts for the year. Some numbers expected 2 cuts, some only 1, some none, maybe even some thought more cuts were needed. It reflected differing views on inflation, jobs, and the right policy path.
And external stuff, like politics or trade policy, can muddy the waters even more.
Oh, absolutely. The potential impact of President Trump's tariffs was a big uncertainty factor mentioned. Tariffs can push up inflation by making imports more expensive. As North pointed out, if tariffs stay high or increase, the Fed might be very reluctant to cut rates because lower rates stimulate demand, and they wouldn't want to fuel inflation that's already being boosted by tariffs.
So the Fed might feel its hands are tied by other government policies.
It definitely complicates their job. And Thierry Wisman noted that sometimes the financial markets get way ahead of themselves, pricing in lots of rate cuts, while the Fed's own signals, like the dot plot, show much less confidence or more caution.
It really highlights the risk of getting it wrong, making a policy error.
That risk is always there. Monetary policy is a blunt tool, as they say. Raising rates cools the whole economy, not just the specific parts that might be overheating. The danger is doing too much and causing a needless recession, or doing too little and letting inflation get out of control. And since they're using backward-looking data, it's easy to misjudge where the economy is actually heading.
And history isn't exactly encouraging on that front.
The track record is tough. Roberto Perli's analysis cited in the sources is sobering. 8 out of the last 9 times the Fed significantly tightened policy raised rates. A recession followed eventually. Those aren't great odds.
And the Fed is aware of these past episodes, trying not to repeat mistakes.
They definitely have historical ghosts they think about. The big one is the 1970s. They cut rates too soon. Inflation came roaring back even worse, and Paul Volcker had to induce a really deep recession later to finally break it.
So fear of cutting too soon.
Right. But then there's the more recent experience under Powell himself, initially judging the post-COVID inflation surge as transitory and maybe waiting a bit too long to start hiking rates aggressively.
So they were maybe slow to hike then.
Yes. Which leads to Mark Zandi's burned child analogy for the current situation. Having been burned by delaying hikes before, are they now perhaps overly afraid of cutting rates too soon? Could that fear lead them to keep policy too tight for too long, even if it risks harming the job market more than necessary? It's this constant tension between the risks of acting too early versus acting too late.
Okay, we've really focused on the U.S. impact. But you mentioned earlier the Fed's decisions echo around the world. Let's talk about that global ripple effect. How does what the Fed does affect a country like, say, Vietnam, based on your sources?
That's a great example because the U.S. Fed's actions have profound global consequences. The size of the U.S. economy and the dollar's role mean their policies are felt everywhere. For a country like Vietnam, there are several key channels.
Okay, what's the first one?
Global growth. When the Fed tightens policy and U.S. financial conditions get tougher, it tends to slow down not just the U.S. economy, but global growth prospects overall. Slower growth in major economies like the U.S. and Europe means less demand for exports from countries like Vietnam.
Makes sense. Fewer orders for Vietnamese factories if Americans and Europeans are buying less. What about the exchange rate, the dong versus the dollar?
That's a huge one. When the Fed raises rates, U.S. assets paying those higher rates become more attractive to global investors. They buy dollars to invest in the U.S., which pushes the value of the dollar up against other currencies, including the Vietnamese dong, VND. This puts pressure on the dong to depreciate.
Does Vietnam just let its currency fall?
Not entirely. The sources indicate the State Bank of Vietnam, NHNN, uses what's called a flexible exchange rate policy, but they actively manage it. They have built up substantial foreign exchange reserves, which they can sell to buy dong and support its value if needed. Plus, Vietnam has some built-in buffers like consistent trade surplus and steady remittances from Vietnamese working abroad, which help supply foreign currency.
So they can cushion the blow somewhat?
Exactly. The data in your source shows that even with the big Fed hikes from 2022 to 2024, the dong's depreciation against the dollar was relatively moderate, maybe around 2–3%. That suggests their management tools and underlying strengths worked quite well.
What about Vietnamese companies or the government itself owing money in U.S. dollars? A stronger dollar must hurt there.
Absolutely. That's foreign debt burden risk. If debt is denominated in USD, a stronger dollar means it takes more dong to make the same dollar payment on interest or principal. The source estimated Vietnam's foreign debt was around 39% of GDP back in late 2021, so it's a significant factor. Also, tighter global financial conditions just make it generally harder and more expensive for Vietnamese entities to borrow new money internationally.
Okay, borrowing gets tougher. What about money flowing into Vietnam? Investment.
It's a mixed bag here. Foreign direct investment, FDI, things like building factories, long-term commitment seems to have held up pretty well. Vietnam is seen as a key place for companies diversifying supply chains, and that strategic trend seems less sensitive to U.S. rate hikes.
So companies are still setting up shop there.
Largely, yes. But foreign indirect investment, FII, that's more like portfolio flows, buying stocks and bonds that's much more sensitive to global interest rates and risk appetite. Your sources note Vietnam did see some FII outflows when U.S. rates rose, as investors sought higher yields elsewhere, but the market seems somewhat braced for it.
And do Fed rate hikes put pressure on interest rates inside Vietnam?
Indirectly, yes. To prevent too much capital from flowing out chasing higher U.S. yields, and to help stabilize the exchange rate, the NHNN might feel pressure to raise its own domestic interest rates. The source material mentioned expectations back in late 2022 for VND deposit rates to rise by maybe 20-40 basis points.
Which means banks pay more for deposits.
Which then puts upward pressure on the lending rates they charge businesses and consumers in Vietnam. Costs go up.
Did the Vietnamese government try to offset that?
They did. They announced support packages like a substantial interest rate subsidy program, 40,000 billion VND, aimed specifically at lowering borrowing costs for pandemic-affected businesses and key sectors like SMEs, tourism, transport. The idea was to cushion the blow.
Did it work?
Well, the source adds a slight caveat. The net effect might be less than hoped if banks just raised rates on other loans to make up for the subsidy and their higher deposit costs. But the government was clearly trying to be proactive. The NHNN also guided credit growth towards productive sectors and away from potentially riskier areas like real estate speculation.
So it sounds like Vietnam used a whole suite of tools, exchange rate management, reserves, subsidies, credit guidance, to navigate the storm created by Fed tightening.
Exactly. It shows how emerging economies have to actively manage these external pressures. Flexible exchange rates, strong reserves, controlling domestic inflation, promoting public investment, improving the business climate. These are all parts of their strategy to maintain stability when the world's dominant central bank makes big moves.
Wow. Okay, this has been incredibly insightful. It really paints a picture of just how far the Fed's influence reaches, from the interest rate on your credit card or savings account to the ups and downs of the stock market, the health of the job market here.
All the way to impacting trade, exchange rates, and borrowing costs in a place like Vietnam. It truly underscores the Fed's central and incredibly complex role in the whole global financial system.
We've covered so much ground, how their decisions hit your borrowing costs, your savings yield, even your chances of getting a loan approved, how it affects your investments, your purchasing power through inflation, and ultimately your job security.
It's this constant high-stakes balancing act they're performing, trying to keep the U.S. economy on track with those domestic goals of stable prices and full employment, while knowing their actions have these huge global consequences.
So, bringing it all together, considering the Fed's history, these tricky choices they always face, the current landscape, juggling inflation fears, unemployment worries, things like trade policy popping up, and the fact they're always driving by looking in the rearview mirror with data, how much certainty can anyone really have about what they'll do next, about where rates are truly headed?
That inherent uncertainty, that might be the biggest takeaway, honestly. There are just so many moving parts, so many potential surprises. Forecasts are just that, forecast.
Right. So what does that deep, unavoidable uncertainty mean for you listening right now? How should it shape how you approach your own finances, making decisions about saving, spending, investing, borrowing, when the path ahead is never perfectly clear? That's something to really chew on as you navigate your own financial journey.